This stock is Tapestry, ticker symbol TPR. Used to be Coach, then they bought Stuart Weitzman, a women's shoe apparel, and then they bought Kate Spade, so women's fashion. Now, when we're looking at some of the financials, one thing that sticks out is PE ratio of 6.6. We mentioned anything below 15 is good. This means that if you bought the company in 7 years, pretty much the earnings from the company would make back all your money. So really cheap. Companies usually aren't this cheap. Now the question is, why is it so cheap? So first of all, let's focus on their 2020 initiatives. What can they accomplish? Innovation? Yeah, they could still work on artistic innovation, engineering in the next year, even if their stores aren't open. They want to focus on the Chinese consumer. We'll talk about this more, but this is a little bit scary. Why? Well, of course, China might be really badly affected. First of all, they were the first ones hit by the virus, and number two is, well, they've been not only closed, but people, even once they open, might not be buying from them nearly as much because other countries are closed down. And number three is, well, there's people talking about fomenting revolution against the government. That's not going to go so well. If it really, even if it's an attempt, and especially if it actually happens. Digital and data analytics, yeah, of course they can work on that, and trying to leverage the multi-brand structure. We'll talk about that more in a little bit, but that's of course something that can happen. So most of their strategic initiatives are going to be possible even if their stores remain closed. Okay, let's just take a look at their stock price, and that red line is the moving average, and the blue line is the stock price. So you can see that it's almost down to $10 right now. And of course, it's not been that except for at the very end of the crash in 2008, it was this low. And this might be the beginning of the crash. So we're already at a pretty low number for this stock. And it's really not been this cheap for the past 20 years. So really cheap, even just without the PE ratio, it's already really cheap. But of course, it's been going down for the past year or more. The S&P 500 crashed, let's say 25%. This crashed almost 60%, from $30 to $10, 75%, whatever it is, or 50%, $30 to $15 now. So this is taking a hit. Now, one reason is they mentioned that if they stop paying dividends, then they'll be negatively affected, their stock price. And of course, people expected it, and now they announced they are going to stop paying dividends. They do mention that they want to pay dividends in the long term, so presumably they'll bring it back eventually. They also stopped their share repurchase program that still has $600 million. That means if I had stock, my stock would presumably go up in value because the company would be willing to buy back stock. So they're not doing that right now. They stopped that, which makes sense. They want to have some cash. Now, in terms of the stock price and the dividends, once we're talking about this, it's kind of been in the past, let's say 10 years, from $20 to $60 stock price. Their dividend payout has been growing. We mentioned that that's a really positive thing, that they keep growing how much money they give you each year. And their dividend yield has mostly been below 5% for the past 10 years. And right now it's at 10%. Of course, the reason is because people didn't think they were going to get any dividend, so they weren't really concerned about that. But that's a really important point to mention, is that eventually they might bring back their dividend. And if you buy it now, well, when they do bring back that dividend, you will be getting 10% of your original purchase, right? So if right now you buy the stock for $10, well, when they bring back their dividend, they'll be giving you $1. Now, maybe the stock price will be a different price, but higher or lower, but you'll still have that dividend, presumably. Okay. So what is their revenue? How much money are they making before all the deductions? So that bottom line is $4 billion. They've been kind of around that $4.5 billion for the past, 7 years. 2018, it jumped $1 billion. Sounds good, but that is specifically because they bought Kate Spade that year, and Kate Spade brought in another $1 billion of sales. So don't be too, deceived by that number. And if we look at the longer range of their revenue, so that top graph is, their revenue over 20 years, let's say. The last year or two, it's kind of been stagnant. Yes, there's that jump from Kate Spade, but it's just kind of stagnated. Now, these quarterly kind of spikes and movements, that's just seasonal because of fashion. People buy in stuff at different times. Definitely not an expert, but you can see that those spikes kind of happen for the past 20 years. Now, once again, what was the growth in their revenue, right? That's what these green bars show positive growth, red bars show negative growth. And besides that 2018 Kate Spade purchase, there's not much. And if you go before that, for another like 4 or 5 years, it's mostly negative growth, right? That's not good. Now, of course, before that, there's great growth. Now, but here's the thing, right? We have 20 years here, or really actually 14 years here. And if you ignore the Kate Spade purchase, it's mostly been negative growth. Now, before that, the previous half, they've had positive growth. So that probably is what's contributing to this negative stock price, is that they are really not growing in sales, except for buying a company, which is not the greatest way to grow in sales. It's an easy way, but it's not as impressive, I suppose. Now, one negative thing to mention is Coach sells through 1,600 wholesalers. That means like Macy's and Saks Fifth Avenue. Of course, these places are losing money. They're closing. Malls are closing. They do mention, though, as a positive, that there's no one person who, if they disappeared, Coach would, for example, lose 10% of their sales. There's none of the same applies to Stuart Weitzman or Kate Spade. Now, we just talk about stores while we're on the topic. A really interesting thing here is that when we look at Coach, specifically on the right, you can see kind of that store total stays the same, 986, 987, 962. But if you look at the left column, North America, you can see it's going down, right? If you start at the bottom of the chart, it goes 419, then 402, then 391, right? The stores are going down in North America. What's happening if the total is staying the same? Well, Coach is selling stores in North America, building stores internationally. And the reason why this is really good is because as they have more stores, they have more places that it makes it easier and presumably cheaper to sell things online, right? They have a place that's holding inventory besides selling their inventory, but it's also building their brand awareness. So I think that's actually a really good sign for Coach, that they're really trying to focus on growing their market share. Same thing applies to Stuart Weitzman. Their North America kind of stays the same, a much lower store count, of course, but internationally, they're growing quite a large amount. And their total stores have gone from 81 to 150 in the last 2 years, so doubling. Now, if they have so few stores in North America, one of the results is 40% of their sales come from these places like Macy's, Bloomingdale's, and that's not so good for any of these companies. And the reason is because they mention what are the negative things that will affect their sales. Well, they mention shifting towards online shopping, decrease in mall traffic. That is going to be a negative for them. That's not good. First of all, they'll have fewer sales, but also they'll get a store impairment charge. Means they have an asset of a store, they own a store. Well, that store is less valuable if it's not doing well, and so their assets might go down in value. Now, one of the things they mention in terms of market growth is they mention they want to grow in Asia. Of course, they mention a number of problems besides what's happening now is employment, labor, transportation, logistics, real estate, environmental regulations, local reporting, legal requirements, all these different things that are so different in different countries. And beyond that, there's also different tastes when it comes to fashion. And also, once they invest in a market, well, they won't get that gain until possibly much later. One of the positive things in all of this is that once they do it for one company, it will transfer to all the other companies. So that actually is pretty good. They mention in market growth, once again, not so good, a focus on the Chinese consumer. Now let's take a look at what that kind of means. So if we look at net sales and we look at Stuart Weitzman last year, you can see $80 million it comes from Greater China. That's 4 times the rest of Asia. So it's a really strong focus for Stuart Weitzman in China. Now, Kate Spade, it's almost the opposite. They have the rest of Asia versus Greater China. And Coach is kind of 50-50 there in both equally. But still, Coach gets almost $1 billion from China. So China being such a big question mark is a little bit scary. And just to make things a little bit worse for at least Stuart Weitzman, you can notice that they have $389 million in sales for that year, and the previous year it's only $373. So still a growth of $16 million. But if you look at Greater China, well, they doubled their sales from Greater China from the year before. So why is it only a $16 million increase? Well, if you look at North America, they went from $240 million down to $216 million. And of course, it was even higher 2 years ago. So it looks like Stuart Weitzman is doing worse and worse in North America. Maybe that's because of wholesalers closing and being negatively affected, really hampering specifically Stuart Weitzman, it looks like. Or maybe it's just because the brand is not doing so well in North America. It's hard to tell. But it's a double whammy because, first of all, Stuart Weitzman is growing in China specifically in leaps and bounds, and China might have serious problems, and it seems to be having a lot of damage in North America. Now, some good news, e-commerce. So Coach has specific different informational websites, it seems like in Hong Kong, Korea, Malaysia, Singapore, and Taiwan. So they could convert those to e-commerce, right? Those are easy ways to grow their sales in these countries. Same thing with Kate Spade in mainland China, right? We mentioned that the rest of Asia has a lot more sales for Kate Spade. Well, they could do e-commerce in China. And of course, they can use Kate Spade and Coach, what they know from Coach, to really try and grow in China as well. So assuming China does well, that's I suppose a positive there. They're building their software systems to help manage, their whole business that will finally be implemented in 2020. So that should help with their profits, let's hope. In terms of accessories, really interesting thing is Kate Spade used to pay Steve Madden to make their footwear, but that's all over now. And of course, Kate Spade is going to do it in-house, which I presume means using Stuart Weitzman either directly or indirectly, all of the things they know. So that is a really positive thing. It means that they'll make some more money on that footwear, possibly. Better margins. In terms of diversification, they mentioned Stuart Weitzman has, pretty much 30% in Spain of producers, and they want to kind of shift and diversify, which makes sense, especially if they're going to be producing shoes for Kate Spade, which has a more global reach, I suppose. But nevertheless, I think because it's mentioned somewhere else in the 10K, they mention the fact that they are having supply chain operational challenges, and I think that they're trying to diversify to really avoid what was happening possibly in Spain. I'm putting two and two together, but nevertheless, the diversification will hopefully help with their operational challenges. Now you can see the cost of goods sold. It's going up, which is not good. That means that they're making less profit. Their operating expenses are going up. Presumably those are all related. Their operating margins going down. So you can see that this was a problem even before Kate Spade was brought in. This is not just because they purchased the company. It's because their operating margins, they're just getting worse at making profit for whatever reason. I did notice that they have more employees. I don't know if that's the problem. It's hard to tell. But obviously, hopefully the new software and hopefully diversification of their supply chains, hopefully these things will solve themselves. Their inventory almost doubled. Well, that might be because of Kate Spade, in fact. Their liabilities, what do they owe people, seems to be going up. And if you look at a bigger, longer graph from the past, 14 years, it's worse. It looks like they just keep growing and growing debt, which is not great. Of course, in the next year, they're going to owe $1 billion, but maybe $400 million of that are inventory purchase. Well, maybe they won't have to exactly do that, and maybe there's a way to get around it. Just because people might not be producing the products, people might not be buying the products, but the lease, I'm sure they'll have to pay that. The good news is if they sold everything, they would be able to cover their debts by a whopping margin of 2.5 times right now, and so they're pretty much financially stable for quite some time, because of course they're going to make money even in the recession, but on top of that, even if they didn't make money, they could go for another 2.5 years. So that's really positive, and of course they can borrow more money because they don't have to sell their assets. They could just borrow money on top of that. Now, if we look at the time of the recession, you can see they made $2.3 billion in the United States in 2009, right? And that's pretty much up from 2007. And then their total sales, you can see, are $3.2 billion for Coach. Now, just keep that in mind, because you can see in North America here, Coach is pretty much the same 10 years later, 2.4 billion versus 2.3. But their total has gone up to be 4.2 billion, and that is because of what it seems like is Greater China, which is not so good. So as much as they've grown sales, but sadly it has to do with relying on China, it looks like, and that will negatively affect their net sales presumably in the coming years. Now, this is their operating income, and so, it's continually going down. They're not making profit as much on their sales. So as much as their sales are going up, their profit's not going up. It's in fact going down, which is not good. I mean, they might be making more money, absolutely, but the profit that they could be making is not as great. So what is a fair price? Well, that's a really hard question because they are really focused on China for their growth right now. And of course, they're having a lot of problems with their operating margin. And that's presumably why you see this really negative price. Now, the truth is it's really cheap right now. I could see buying it even now. I think the stock will go down a little bit more in value. They're going to really, either China will have to really come back from all of this. That's one option, in which case, Tapestry will be doing well because they have all this, investment in China. But presumably they're going to have to focus on other areas, either in Asia or Europe or Africa, so that whether or not China does or doesn't come back, they will still have areas to grow. The positive thing I will mention about this company is even if they don't grow, they have a lot of opportunity to improve their operating margin, to improve their profit on every sale. So that is really my feeling for why there's a lot of value in this company. Number one, it's so cheap. Number two is they can improve their profits even if they don't improve their sales. And number three is they have so much money right now that they can last for another 2.5 and presumably more years going forward. Now, just as another side point of what is a fair price. So you can see for the past, let's say, 15 years, just looking at their stock price, it's fluctuated from $20 to $60. This is kind of the cheapest it's been. In terms of their earnings per share, that middle graph, you can see it's kind of all over the place as profits have gone down for the past, let's say, 10 years. Obviously their earnings per share have gone down. Now, if we look at the bottom graph, that's their PE ratio. That's that price earnings. So right now it's 6.6. It's hardly ever been this cheap for their price earning ratio. Once again, in 2009, it got this cheap, presumably at the end of the bear market. Other than that, it's really never had a price earning ratio this good. But how good is good for them? Well, it's not going to be 20 like it was for Coke that we were mentioning last time. It looks like it's always above 10, maybe around 15 on average, which we mentioned before. That's kind of the average fair price. So, Tapestry right now being 6.6, 6.7, it's possible that you could double your money if right, the company comes back. And that right now is relying on two things. Either focusing on greater China and hoping that greater China comes back and becomes an economic powerhouse again. Or number two is that they kind of pivot and focus on different markets. Of course, in the meantime, they can work on their operating margin, but I don't think that's necessarily going to be enough because, if China doesn't come back, that's going to negatively affect their sales, of course. So if you have money, I'm not a stock market advisor, so I can't. This is just my opinion. If, let's say, I had money, I shouldn't say if you had money. If I had money and I had it for the stock market for a long time, 5-10 years, I think it's a safe bet, that this company will come back. They'll figure out ways to grow the market even if China doesn't come back. They'll figure out how to improve their operating margin. They'll bring back their dividend. All these things are really positive things about this stock that makes it, I think, for the long term, good buy right now. I think the stock will go down. Maybe it's a good time to already start buying. I'm not sure. But just a small amount now and just increasing as it goes down. But once again, this is only if you're going to be in this stock for a long time. It's a little bit of a gamble. I wouldn't put a large portion of my stock market, pick into this. But it is something that is really cheap, really promising, has a lot of, I think, value to it. I don't think it's going anywhere, and I think they have a long time to figure out how to pivot, right? That's also important, that they have the time to work on solving all of their operational issues.